So a lot of founders, raise a little bit of capital, are building their SaaS startup, not really found PMF. It's kind of pushing a boulder up the hill, spent a few years, maybe got to somewhere like low single digit million ARR, but that too with like not very strong PMF, really no growth in the business. The founder is like, look, I don't see a future for this company, but you have raised money from investors, or you have investors, VCs on the cap table. So there is a responsibility to create an exit for everyone, right? And so I see so many SaaS founders in this situation. They want to create some sort of a salvage exit, right? So it could be an acqui-hire, maybe investors get some sense on the dollar back. Um, and this is kind of very uncharted territory for most founders, right? Because they're obviously experts in their own domain and in building products, but not in doing these kind of deals. So what can founders do when they're sort of in this kind of a scenario to create such an exit, an acqui-hire exit, or some sort of a salvage exit, maybe even an asset sale?
Yeah, no, I mean, and you mentioned some of the ways that they can exit out. It's actually really important for founders to educate themselves in the M&A market probably sooner than later, just so they can understand that, okay, if my runway is ending at a certain point, they can actually start having, they've built value. So they have value, whether it's an acqui-hire or their assets, et cetera, that they can actually, instead of going to a VC and asking for money, they can go to a PE and say, we've got some pretty interesting, we're in a pretty interesting situation that might be of interest to you. We're in the low air, million ARR. We're a bit stagnant, and here's the reasons why we're stagnant. PE firms would probably understand that and know that they can use that value to enhance something in one of their verticals, right? So that's the thing. So if it is some sort of an exit you're looking for, just be proactive and speak well to your company. It doesn't matter what situation that you're in, don't crawl your way to knocking on the door. They'll see that. Obviously, it's not necessary. They'll know where you are, but still show excitement in what you're doing. That's always really, really important. So it's not a distress sale. It's a, new avenue for the company that has value that can be added somewhere else, right? So look for the right buyers, right? And so not everyone's going to be interested. But is it another mid-sized SaaS company? So that could be a nice acquisition from them. Could be a competitor. Could be private equity, like we talked about. It could be one of your customers. So Madhu mentioned this, right? So it could be one of your customers that could find interest in what you're doing. And then so they could infuse capital within your company, maybe not, like a typical round, but a couple $1 million. You're now added into the company. Now you're a product or an add-on, a product to their platform one way or another. So, so stay malleable in your thinking around that. And then the just say this is a strategic play. We're going into this new situation. We have strong IP. We've got strong tech. We've got a strong customer base. Our team is fantastic. So again, you have assets. You have value. Speak to that value, and I think that's very, very important. And then I think at some point, founders will know where the fork in the road goes, and you're like, we really need money, or we're going to close down, or we need to figure out another avenue for this company outside of fundraising, through this form of exit and potential acquisition. So knock on the doors. Just as much as you put enough energy and effort around investor relations, this is the same form of relations where you're talking to potential customers around, hey, what do you think of our product? What do you think of our team? Do you think this is something we're looking for an avenue of exit here early on? Obviously, it's going to be at a discounted rate, tremendous discounted rate. So you're going to know which customers you're going to go to or not. Back to my initial point, like know who the buyer would be. And then, if you are at a high enough ARR, and Madhu always, hounds on this, like, uh, talk to a boutique investment banker, right? Who are able to help you. Maybe obviously not the large ones, but there will be ones that are going to be able to kind of help you position yourself in such a way where this is not a bad, like, yeah, you have strong enough assets. We can talk to some of our network to see if there's interest, et cetera, et cetera. So I would say initially just get the education, know that M&A, as an opportunity for early stage companies is an avenue that Sumitra, to your point, isn't really talked to enough. And so everyone's going to that same routine of we need funding, we need funding. This is a bridge round, this is this, that, and the other. Like, nah, you can be out. go out, go start something else. The market is moving quickly, and whether it's an asset sale, stock sale, et cetera, like there are tools for you to use early on. So those are my main points. And if you start that route, know that it's like a 4 to 6 month process, could be longer depending on where you are and how sophisticated the operations are. And if your data room is very clean, and there are no major issues during the due diligence, yeah, that could happen. So within 6 months to a year, if you know the route of fundraising is not going to happen, look at M&A and look at these opportunities.
And I'll probably touch on something that equally, I believe, isn't addressed. And Hans, you made a point about educating the founder, educating themselves on these opportunities. I'll probably take it a step further and say, if you're starting a company today, arguably, if you started a company maybe even a year ago, one of your responsibilities to yourself and to your company is to be very aware of what paths to liquidity look like on day zero. Have that in your mind. The Valley, sort of for a variety of reasons, good or bad, has glamorized raising capital above everything else and unicorn exits above everything else. Understandably so, but not without some difficult repercussions, especially when capital markets are not great and interest rates are not great, right? So
And
if
Madhu,
I am giving it
you can't say there's no plan B unless you succeed, right? Otherwise, we all know
right,
what that really means, right?
that's right. And it is imperative for every founder today to educate themselves on paths to liquidity in a variety of scenarios. So that's one thing I'll say. The flip side of the coin that people also don't talk about is this is probably a little bit sort of psychology and that realm of things is you are not your company. Okay. Nobody, you first and foremost should not judge yourself on the success or failure of your company. If you can healthily detach, look, this is an endeavor, this is a chapter in my life that I am building with my team and with my investors, then it actually positions you much better in looking at that entity as an asset and how creative can I get in finding a home for one of the entire of the asset or parts of the asset, right? The moment you think I am my company, then there's an emotional component. Then you are feeling a sense of failure, desperation, judgment. All of those are going to prevent your creative faculties in trying to find the right path. So you are not your company. You are building a company. You're a big pie chart, and a company is a piece of your pie chart in life. It may not seem obvious, but I hope at least some of the listeners recognize that that is actually a very important and healthy way to think about your company. Not only that, it's also a very valuable way to look because now you have a healthy detachment and you can say, what can I do with this thing I built versus what should I do with myself? Which is a horrible, unfortunate, unnecessary implication when you're building a company. Those are two things I wanted to add to what Hans is saying.
Yeah, no, very well said. A couple of points on this from my side. I think one, I recorded an episode with Satya Ghani, who's the CEO of Beamer. So Satya has sold 5 companies in 15 years.
Yeah,
That's
So,
it.
amazing.
Oh,
so
he's
clear.
slacking. What's going on here?
So clearly, there is a method here, right? Like there is a process at play. There's a framework at play here, right? So it's not that it's not doable. That you can intelligently create liquidity and exit options. So that was one. And then second was I also encourage founders to really lean on the VCs on their cap table because VCs oftentimes have very large portfolios across multiple funds. For them, it's much more easier to kind of merge portfolio companies together or even do acqui-hire situations. And typically, a lot of times, the board member can be common as well. And I think the onus is also on the VCs to make sure because, also the founder, you want the founder to be still in the game, right? But you also want to back the next company. So it's in actually everyone's interest that, you get a win out of this.
That's a great point to call out. Your investors and your advisors, hopefully you pick them well, and they will happily work with you if you are open and upfront and wanting to collaborate with them versus being driven by fear, right? There's a lot of folks that were invaluable to me at the most recent company. I'll sort of shout out to Costa Noah Ventures, Ross Fubini at XYZ, Russ Fraden, who I'm starting to work with again, and a number of others. Right, so they could make a difference between I don't see a light and oh my God, there's 10 other options that. By the way, not to mention, for me, Hanz, before I was part of HKMC, was a source of that. Right, Hanz always. I'll speak about him not as my partner at HKMC, but a friend and a well-wisher in my prior journey. He was sort of like an informal advisor who always said, "You have nothing to be worried about." Whenever I had stressful inflection points. And I couldn't see them as powerfully as he was presenting them because I thought I was my company. If the company has a downturn, I have a downturn. Like, no, that's not necessary. Right? So to your point, your advisors, your investors are a huge source. And I'm sure for the folks that are lucky enough to partner with you, I hope they're listening to this and saying, oh yeah, I need to call Sumitra more often.